Imagine waking up tomorrow to find your entire stock portfolio down 20%, not because of a bad earnings report, but because a single invisible line of computer code shut down an oil pipeline halfway across the world, and the Federal Reserve just announced they will not step in to save you. It is completely normal to feel a knot in your stomach when you hear scenarios like this. The daily news cycle is practically engineered to induce panic, making you feel like the ground is constantly shifting beneath your feet. But here at Warm Insight, we do not react to fear with panic. We respond with clinical, calculated preparation. We look past the terrifying headlines to understand the deep, structural mechanics of the global system, and right now, the underlying mechanics of our financial world are screaming that a massive regime change is underway. Now, you might be tempted to brush off the recent news of escalating tensions, with Iran as just another political drama that will blow over in a week. But top-tier economists, including the legendary Nouriel Roubini, are sounding a 5-alarm fire. If you are not familiar with Nouriel Roubini, let me take you back in time to September of the year 2006. Picture a lavish conference room full of the wealthiest and most powerful economists on Earth at the International Monetary Fund. The mood in the room was euphoric. The global housing market was skyrocketing. People were becoming millionaires overnight by flipping suburban houses. Roubini stepped up to the podium and calmly delivered a presentation, predicting a catastrophic housing bust, a severe global recession, and the imminent collapse of major investment banks. The audience of elite professionals literally laughed out loud at him. They mockingly labeled him Dr. Doom. Exactly 2 years later, Lehman Brothers collapsed. The entire global financial system nearly vaporized, and absolutely nobody was laughing anymore. Roubini possesses a rare ability to see the entire interconnected system, rather than just isolated events. And today, Roubini is explicitly warning us that we are sleepwalking directly into a 1970s-style stagflation trap. To understand exactly what stagflation is, we have to travel back to the 1970s. For decades, traditional economists believed in a very strict rule called the Phillips curve. The Phillips curve, basically, stated that inflation and unemployment were opposites. If inflation was going up, unemployment was going down. The textbook said you mathematically could not have high inflation and high unemployment at the exact same time, but the 1970s violently shattered that academic theory. In 1973, a massive geopolitical conflict in the Middle East caused the Organization of Arab Petroleum Exporting Countries to proclaim an absolute oil embargo. Almost overnight, the global price of oil quadrupled. This is what economists call an external supply shock. Think of it like a sudden, massive, unavoidable tax placed on everything that physically moves on planet Earth. The cost of manufacturing goods skyrocketed. The cost of transporting food doubled. Businesses were forced to aggressively raise their prices just to survive, which caused rampant, painful inflation for everyday citizens. But because their operational costs were suddenly so high, those same businesses also had to fire millions of workers and completely stop expanding. The economy stagnated. Stagnation combined with inflation equals stagflation. It is the absolute worst-case scenario for any economy. Imagine driving a car with the parking brake permanently jammed on, but the gas pedal is stuck all the way to the floor. The engine is screaming, overheating, and burning expensive fuel at an unbelievable rate. But your car is barely moving forward at all. That is what stagflation feels like to a society. In the 1970s, this dynamic led to massive, desperate lines at gas stations, where citizens could only buy gasoline on certain days, depending on the last digit of their license plate number. It was an absolutely miserable decade for investors. The broad stock market essentially went nowhere for 10 long years, while rampant inflation silently ate away the purchasing power of their hard-earned money. This brings us directly to the Federal Reserve and the terrifying collision course we are currently on today. For the last 15 years, ever since the catastrophic 2008 financial crisis, we have lived in an artificial anomaly. We have lived in a dream world of 0%, interest rates, and endless free money. Whenever the stock market got scared, whenever a bank failed or a virus locked down the globe, the central bank would rush to the rescue with a giant financial fire hose, spraying trillions of dollars of cheap liquidity everywhere to instantly prop up asset prices. This conditioned a whole generation of investors to simply blindly buy the dip. But the rules of the game have completely changed. When you have a massive energy shock driven by a geopolitical conflict, like an escalating shadow war with Iran, the central bank is powerless. They cannot print more barrels of oil. They cannot fix a broken shipping lane with an interest rate cut. If we see a massive oil supply shock today, inflation will immediately spike to devastating levels. And this forces the Federal Reserve into a brutal, unforgiving corner. They will have to make a choice between saving the stock market or saving the United States currency. If a highly strict figure like Kevin Warsh were to take a leading role at the Federal Reserve, the response could become aggressively hawkish. The term hawkish simply means prioritizing the aggressive fight against inflation, above all other concerns, usually by raising interest rates incredibly high to deliberately choke the economy. Think of a dovish central bank as a lenient helicopter parent who gives their crying child a piece of candy every single time they throw a tantrum. A hawkish central bank is the incredibly strict high school principal who immediately cancels recess and issues detentions to restore order to a chaotic school. To truly grasp how dangerous this hawkish turn can be, we need to look at the ghosts of the Federal Reserve, specifically the contrast between Arthur Burns and Paul Volcker. In the early 1970s, Arthur Burns was the chairman of the Fed. When the first wave of inflation hit, Burns tragically caved to immense political pressure. He was terrified of causing a recession before an election, so he kept interest rates far too low and let the money supply expand. He foolishly thought the inflation was just temporary. This was a catastrophic historical mistake. It allowed the disease of inflation to embed itself deep into the psychology of the American consumer. People started hoarding goods and buying things immediately because they expected prices to be drastically higher the following week, which ironically created a self-fulfilling prophecy of even more explosive inflation. The United States economy descended into absolute chaos. It was not until 1979, when Paul Volcker took over the Federal Reserve, that the inflation monster was finally slain. Paul Volcker was the ultimate financial hawk. He did not care about the stock market. He did not care about his own political popularity. Volcker ruthlessly jacked the federal funds. Interest rate up to an unbelievable 20%. Imagine trying to buy your first home or get a small business loan, with interest rates sitting at 20%. It was economic chemotherapy. It threw the United States into a severe, brutal, and agonizing recession. Unemployment skyrocketed across the country. Desperate farmers actually drove their tractors all the way to Washington. To block traffic and protest, angry home builders mailed actual 2x4 blocks of wood to the Federal Reserve headquarters, with desperate pleas written on them begging for lower interest rates. But Volcker held his ground like a fortress. He endured the immense public hatred to break the back of inflation permanently. Today, millions of retail investors are recklessly gambling that we have an Arthur Burns at the wheel, someone who will magically pivot and print more money the very second the stock market drops. But if we get a strict hawk like Kevin Warsh, or if the current Federal Reserve realizes they have no choice but to emulate the ruthless courage of Paul Volcker, the modern stock market is going to face a devastating reckoning it has not experienced in 40 years. So why is the average everyday investor completely ignoring this massive threat? The answer lies deep in human psychology, specifically a dangerous mental glitch known as recency bias and herd behavior. Recency bias is a cognitive illusion, where our brains automatically assume that whatever happened most recently will just keep happening forever. To understand how blind this makes us, think about the famous psychology experiment with Pavlov and his dogs. The Russian scientist Ivan Pavlov rang a bell every single time he fed his dogs. Eventually, the dogs would violently drool just from hearing the sound of the bell, even if there was absolutely no food in the room. Modern investors have been completely Pavlovian for the last 10 years. Every single geopolitical scare, from massive trade wars to regional conflicts, was immediately met with a massive injection of liquidity from central banks. The warning bell rang, the stock market dropped, the government printed money, and stock prices went straight back up to new record highs. Investors have been deeply trained by the system to salivate and hit the buy button at any sign of trouble. They are fighting the last war. They expect a rapid, miraculous V-shaped recovery, because that is literally all they have seen since the year 2009. Another incredible way to visualize this trap is the turkey illusion, famously described by philosopher and mathematician Nassim Nicholas Taleb. Imagine a happy turkey living on a beautiful farm. every single day for 1,000 consecutive days. The kind farmer comes out and feeds the turkey a wonderful meal. The turkey uses all of its historical data to conclude that the farmer is its absolute best friend in the world. The turkey feels incredibly safe and secure. The statistical evidence that the farmer loves, the turkey grows stronger and stronger every single day. Then day 1001 arrives, and it happens to be the day before Thanksgiving. The turkey's entire worldview is suddenly, violently, and permanently destroyed in an instant. The massive herd of retail investors today are the turkeys. They are operating on an outdated paradigm of low inflation and guaranteed central bank bailouts that is rapidly approaching its own Thanksgiving Day. To survive what is coming, you have to aggressively break away from the herd. You have to learn to think like a seasoned contrarian. The legendary billionaire investor Howard Marks talks constantly about a concept called second-level thinking. First-level thinking is simplistic, emotional, and superficial. Everyone in the world can do it. First-level thinking says, I just read on the news that hackers linked to Iran attacked a senior government official. Therefore, the world is very scary today, so I should sell all my stocks and hide in cash. Second-level thinking goes much, much deeper. It meticulously looks at the interconnected, invisible web of consequences. Let us map out the exact chain reaction of our current geopolitical stagflation risk together. The first-order effect is simple and obvious. Geopolitical tensions escalate rapidly. We see terrifying headlines about cyber warfare, infrastructure attacks, and proxy battles. Intense fear enters the global market. Institutional capital immediately starts searching for a safe place to hide, pushing up the price of gold, and crude oil prices spike violently. Because traders are terrified that the Strait of Hormuz might be physically blocked, completely choking off the global oil supply. But that is just the first domino falling. Now we must look at the second-order consequence. Persistently high energy prices act as a massive inflation multiplier. Oil is the literal lifeblood of the entire global economy. When energy gets expensive, absolutely everything else gets expensive. This forces the hand of the Federal Reserve. To prevent inflation from destroying the society, the central bank must become highly restrictive. They completely stop injecting liquidity and start aggressively draining it out of the system. Interest rates are forced to stay much higher, for much longer than anyone expects. This leads us directly to the third-order opportunity. This resulting environment, the dreaded stagflation trap, is absolute poison for regular index funds and high-growth technology stocks. Why is it poison? Because growth stocks are valued based on their massive, promised future earnings. But when interest rates rise significantly, the mathematical present value of those distant future earnings plummets like a stone. At the exact same time, rampant inflation crushes corporate profit margins. The companies have to pay vastly more money for raw materials and human labor, but the everyday consumer is far too broke to accept higher prices at the cash register. So the smart money, the disciplined contrarian investor, actively positions themselves ahead of time in the specific assets that actually thrive when the world is burning. They buy energy producers. They buy real, tangible assets that cannot be printed by a desperate politician. How do the absolute greatest investors in financial history handle this kind of terrifying macroeconomic environment? Let us examine the brilliant strategies of Warren Buffett and Sir John Templeton. Fear is currently the dominant, overwhelming emotion in the global market. But these historical titans treat fear as a highly useful signal, not a command to panic. Warren Buffett famously advises us to be fearful when others are greedy, and to be extremely greedy when others are fearful. But he absolutely does not just buy blindly into a crashing market. In a stagflationary environment, Buffett focuses obsessively on one critical metric above all else: pricing power. Pricing power is a company's unique ability to raise its prices without losing its loyal customers. Imagine you own the only physical toll bridge crossing a massive, dangerous river, and millions of people have to cross that specific river every single day to get to their jobs. If rapid inflation drastically drives up your concrete and maintenance costs, you can simply raise the toll fee. People will complain bitterly. They will be very angry, but they will still pay the higher fee because they have absolutely no other choice. That is true pricing power. Contrast that powerful toll bridge with a company selling cheap, easily replaceable luxury items. If massive inflation hits and that luxury company tries to raise its prices, the struggling customer just stops buying the product entirely. Buffett would also be sitting on a massive, strategic pile of cash right now. Yes, holding cash during an inflationary period means you are slowly losing purchasing power. But in a highly volatile crisis-prone market, cash is absolutely not a dead asset. Cash is a strategic weapon. Cash is the dry powder and the ammunition you need to aggressively swing at the fat pitch when everyone else in the market is forced to liquidate their entire portfolios in a blind panic. Now consider the legendary John Templeton. He was arguably one of the greatest contrarian investors to ever live. In 1939, when Adolf Hitler violently invaded Poland and World War II officially began, the global stock market experienced an epic, terrifying panic. It genuinely seemed like the end of the modern world. What did Templeton do in the face of total global destruction? He borrowed massive amounts of money, which was incredibly risky, and he bought exactly 100 shares of every single company listed on the New York Stock Exchange that was trading for less than $1. He bought 104 different companies. 34 of those companies were actually in the middle of active bankruptcy proceedings. Why on earth did he do this? Because he deeply understood a powerful concept. He called the point of maximum pessimism. He knew that things were so unbelievably bad, and the public fear was so extreme that any outcome, other than total global annihilation, would eventually lead to a massive financial recovery. He made an absolute fortune. Now, we are likely not at the exact point of maximum pessimism right now today. This current tension feels much more like the early warning tremors, before the main earthquake hits. But the powerful lesson is exactly the same. Do not run for the hills in terror. Check your climbing gear and prepare your fortress. One of the most fascinating and confusing paradoxes of global finance is what exactly happens to the United States dollar during a massive geopolitical crisis that directly involves the United States. You would logically think that if the United States is locked in a terrifying, escalating standoff with Iran, international investors would panic and flee away from American assets. But the exact opposite happens in reality. In a world of escalating chaos and war, United States assets become the cleanest dirty shirt in the global laundry basket. Why does this happen? Because the complex plumbing of the global financial system is fundamentally hardwired to automatically default to the United States dollar and United States Treasury bonds during times of extreme global panic. It is a well-documented economic concept known as the dollar smile theory. The United States dollar is incredibly strong when the American economy is booming, but it also becomes incredibly strong when the entire global economy is crashing and burning. Think about the rest of the world for a moment. Europe has its own massive, deep-seated structural problems and a rapidly aging demographic crisis. China is currently dealing with an immense, terrifying mountain of debt and a violently collapsing domestic real estate sector. Emerging market countries are incredibly fragile at the best of times. If a massive global oil shock hits, those emerging markets get completely crushed by two heavy hammers at the exact same time. First, their vital energy import costs absolutely explode, draining their wealth. Second, because their national debts are very often priced in United States dollars, a rapidly rising dollar makes their existing debt mathematically impossible to ever repay. So massive waves of panicked capital from all over the world frantically flee to the central source of the uncertainty. Trillions of dollars instantly rush into the United States, seeking the unparalleled depth, the incredible liquidity, and the relative safety of the American financial markets. If a hawkish figure like Kevin Warsh influences the Federal Reserve to keep interest rates punishingly high, it just acts like a giant financial magnet, pulling even more global capital directly into the strong dollar. This dynamic creates a powerful, albeit painful, global shield for American assets, even as the rest of the world burns around us. Let us look at the mechanical, mathematical indicators that prove this massive shift is already happening beneath the surface. The truly smart money, the billionaires and the massive institutions, do not sit around watching the evening news to make their decisions. They watch the hidden plumbing of the financial system. And the single most critical indicator, flashing red right now, is the yield curve. What exactly is a yield curve? Simply put, it is the mathematical difference between the interest rate the government pays to borrow money for a very short time, like 2 years, versus a very long time, like 10 years. Normally, in a healthy world, if you lend someone your money for 10 long years, you demand a much higher interest rate, because there is vastly more risk over a long period of time. But right now, the yield curve is severely inverted. The government is literally paying a higher interest rate for short-term loans than for long-term loans. Imagine walking into a hotel and the manager tells you, it costs $500 for a single night, but only $200 a night if you commit to staying for an entire year. That makes absolutely no logical sense unless the hotel manager is absolutely terrified about what is going to happen to the building tomorrow morning. An inverted yield curve is the bond market, screaming at the top of its lungs that something is deeply, fundamentally broken. It means the smartest investors on Earth expect near-term inflation and Federal Reserve hawkishness to keep short-term rates painfully high, but they expect long-term global economic growth to completely and totally collapse. This is the exact undeniable fingerprint of stagflation. Institutional positioning already intensely reflects this dark reality. We are actively seeing massive quiet capital rotation. Smart money is quietly dumping their passive broad market index funds. They are aggressively buying insurance policies on the stock market in the form of expensive put options, preparing for a sudden, violent drop. At the exact same time, they are relentlessly pouring billions of dollars into energy. Sector funds and physical gold, they are absolutely not waiting for the television news anchor to officially tell them there is a crisis. They are proactively positioning their massive portfolios right now for a prolonged, multi-year period of very high inflation, brutally slow economic growth, and extreme, unpredictable geopolitical volatility. So how do you actually build a financial fortress to survive this trap? Standard, everyday investing advice like traditional dollar cost averaging will get you absolutely slaughtered in a stagflationary environment. If you just blindly buy the dip in a broad index fund every single month, while rampant inflation systematically crushes corporate profit margins, you are just throwing good money after bad. You need what we at Warm Insight call the 50-35-15 seesaw allocation. This is a highly strategic defensive manual for extremely turbulent conditions. 50% of your portfolio stays in equities, but absolutely not just any equities. You need a stable core holding in a broad market index to capture any surprise upside, but you must aggressively complement it with highly tactical positions in the specific sectors that actually survive inflation. This means you need heavy exposure to energy producers. Let us look at the Energy Select Sector Fund, ticker symbol XLE. Geopolitical tension with major oil-producing nations puts a massive structural price floor directly under crude oil. Energy companies literally print massive amounts of cash. When global oil prices are high, you also desperately want defensive sectors like healthcare, because no matter how bad the global economy gets, people will always cut back on luxury vacations before they cut back on their life-saving medicine. 35% of your fortress portfolio goes directly into safe haven assets. This is the heavy shield for your sword. This 35% should be split carefully between intermediate-term United States Treasuries to provide a stable, guaranteed yield in physical gold or a gold fund like GLD. Let us talk about why gold specifically is the ultimate safe haven. In this exact terrifying scenario, when we talk about gold, many arrogant modern investors scoff. They call it a useless pet rock. They say it does not yield a quarterly dividend, it does not produce annual earnings, and it is just an outdated relic of the ancient past. But this is exactly the dangerous recency bias we discussed earlier. Gold is absolutely not designed to make you fabulously rich. Gold is designed to keep you from becoming hopelessly poor. When the entire financial system breaks down, for over 5,000 years of human civilization across absolutely every continent, and through the rise and fall of every single empire, gold has been universally recognized as the ultimate store of human value. Why is this true? Because of its unique physical properties. It is totally indestructible, it is extremely scarce, and most importantly, it cannot be digitally printed out of thin air by a desperate central banker sitting in a boardroom. During periods of massive inflation, fiat currencies, which are essentially just pieces of paper, backed by the flimsy promise of a highly indebted government, rapidly lose their purchasing power. A $100 bill buys you significantly fewer groceries today than it did just 5 years ago. But an ounce of pure gold will generally buy you the exact same amount of goods today as it did 100 years ago. When you combine raging inflation with severe, terrifying geopolitical instability, like the escalating shadow war with Iran, you create an absolute perfect storm for gold to thrive. Investors suddenly become terrified of counterparty risk. They realize that a modern stock is just a digital claim on a fragile company, and a treasury bond is just a paper, IOU, from a government that is currently drowning in trillions of dollars of debt. In a true, terrifying crisis, people desperately want an asset that has zero counterparty risk. If you hold a highly liquid gold fund, you own an asset that absolutely does not rely on anyone else fulfilling a promise. It is the ultimate historical financial insurance policy. Finally, the most critical part of this entire survival strategy is maintaining an elevated 15% cash reserve. In a normal, healthy bull market, holding 15% of your net worth in cash is a drag on your returns. But in a geopolitical powder keg, cash becomes your absolute superpower. This is absolutely not your emergency fund, cash to pay your monthly rent or buy groceries. This is purely opportunistic, aggressive capital. We use a strategy called crisis dollar cost averaging. You absolutely do not use this precious cash to buy a tiny 3% dip because the monthly jobs report was slightly bad. You keep this powder completely dry until a massive news-driven dislocation occurs. You wait patiently until there is a confirmed hostile military action, a massive infrastructure cyber attack, or a major geopolitical escalation that causes the entire stock market to violently drop 10% or more in a matter of days. That is exactly when you deploy the cash to buy the panic. To execute this strategy safely and survive the chaos, you must employ totally ruthless risk management. We operate on a very strict 50% rule. This unbreakable rule states that if any single non-core tactical position in your portfolio falls by exactly 50% from your original purchase price, you must automatically sell half of it. No questions asked. No hoping it magically comes back up. No rationalizing the loss. This sounds incredibly painful, and it truly is. But human beings are psychologically incredibly bad at cutting their losses. We become deeply emotionally attached to our investments. We desperately want to be proven right. But in a volatile, stagflationary environment, a bad investment will not just go down a little bit, it will eventually go to absolute zero. Selling half of your position at a 50% loss is not admitting embarrassing defeat. It is a clinical, mechanical, professional tactic to prevent a single bad thesis from permanently destroying your family's wealth. It completely forces you to pause, step back, and deeply reevaluate if your original idea was totally wrong. Right now, there are very clear, dangerous actions you must actively avoid. Do absolutely not reach for yield in long-duration bonds. In the 1970s, style inflation that Nouriel Roubini warns about rapidly. Rising interest rates will absolutely decimate the value of long-term bonds. It is a classic, devastating trap for terrified investors who desperately want safety, but do not understand the brutal mathematics of inflation. And above all else, do absolutely not dismiss these geopolitical events as just temporary noise. State-sponsored cyber attacks on senior government officials are not random market wiggles. They are massive structural shifts in the global risk landscape. What does this structural shift look like for specific sectors of the economy? Let us take a highly granular look at the global airline industry as a perfect real world example of how stagflation completely destroys business models. The airline sector right now is flashing a massive, terrifying bearish signal. Airlines operate on notoriously razor-thin profit margins, even in the best of times. Their two biggest, unavoidable expenses are jet fuel and human labor. In a geopolitical stagflation scenario, both of these massive costs explode simultaneously. When tensions with Iran spike, the global price of crude oil surges, which immediately translates into exorbitant jet fuel prices. The airlines are forced to pay this astronomical cost, just to keep the planes in the sky. At the exact same time, rampant inflation is driving up the basic cost of living, which means labor unions angrily demand massive wage increases. And we are already seeing deep domestic political friction causing massive disruptions. Look at the recent pay disruptions for airport security personnel. When a government faces reduced capacity to effectively manage its own internal infrastructure due to political infighting and severe budget crises, the daily friction in the system exponentially multiplies. You suddenly have airports experiencing massive cascading delays, highly frustrated travelers, and an incredibly strained, angry workforce. This is an internal demand destruction event. So the major airlines are getting brutally squeezed from both sides. Their operational costs for fuel and labor are skyrocketing out of control, But because the broader economy is rapidly slowing down, and everyday consumers are feeling the painful pinch of inflation at the grocery store, significantly, fewer people are booking vacations. The airlines cannot simply double the price of an economy ticket to cover their massive fuel costs, because consumer demand is highly elastic. If the ticket is far too expensive, the family simply stays home. This is the classic terrifying margin squeeze. Rapidly rising input costs combined with violently collapsing consumer demand. This dark dynamic will absolutely shred the balance sheets of any company that does not possess absolute pricing power. Meanwhile, the broader market, represented by the S&P 500 Index Fund, or SPY, is incredibly fragile right now. Think of the S&P 500 today as a giant, towering Jenga puzzle that has been built incredibly high into the sky, but someone has secretly pulled out all the sturdy, supportive blocks at the very bottom. The massive tower is currently being held up by just a tiny handful of massive technology companies. These specific companies are priced for absolute, flawless perfection. Delirious investors are paying astronomical multiples for their distant future earnings, blindly, assuming that the economy will just keep growing forever, and interest rates will soon magically go back down to zero. But stagflation is the violent gust of wind that knocks the entire Jenga tower over. If inflation stays stubbornly high because of an unstoppable global oil shock, the Federal Reserve mathematically cannot cut interest rates. If rates stay painfully high, the mathematical discount rate applied to those technology companies, future earnings goes up significantly, which means their current stock valuation must come crashing down drastically. At the exact same time, the hundreds of regular, everyday companies inside the S&P 500, the manufacturers, the local retailers, the consumer goods companies, are getting brutally crushed by the exact same margin squeeze we just talked about with the airlines. Their operational costs go up, their consumer sales go down, and their corporate earnings completely collapse. So you have a highly dangerous situation where the broad stock market is facing a dual threat. The valuation multiple is violently contracting because of high interest rates, and the actual underlying corporate earnings are contracting because of the rapidly slowing economy. This is exactly why our Titan playbook recommends extreme caution with broad index funds right now. You absolutely cannot just blindfold yourself and throw your hard-earned money at the market. You have to be highly tactical. You have to actively allocate your capital to the specific, resilient sectors that actually benefit from this chaos, like energy and commodities, while aggressively and ruthlessly defending your downside risk. We are standing on the very edge of a fundamental historic regime, change in the global economy, the peaceful era of low inflation. Quiet borders and endless central bank bailouts is officially over. The broad consensus of regular investors right now is still completely asleep at the wheel, blindly, hoping that the Federal Reserve will magically fix a broken global supply chain and geopolitical warfare with a simple interest rate cut. But when inflation gets completely out of control, due to a massive global supply shock, the central bank's legal mandate forces them to make a brutal, historic choice. They must either crush the inflation or try to artificially save the stock market. History, politics, and cold mathematics all dictate that they will absolutely choose to crush inflation, even if it means deliberately plunging the entire economy into a deep, painful recession. That is the exact moment the entire investment landscape changes overnight. This is absolutely not a time to try and guess the exact day. The market will fall. It is a time for serious, calculated preparation. It is a time to fortify your hard-earned assets. Build your financial fortress portfolio and clinically observe the blind panic of the herd from a position of absolute strength.